Let me extend a very warm welcome to you all to this panel, Strengthening the Stock Connect channel. Before jumping into questioning this fabulous panel, let me provide some brief introductory remarks. The China-Hong Kong Stock Connect programs create a single China stock market that ranks as one of the biggest in the world by market cap and daily trading turnover. Commonly known as Connect, the link was first launched in November 2014 between the Shanghai and Hong Kong exchanges and was extended in late 2016 to encompass the Shenzhen market. It allows mainland Chinese investors to purchase select Hong Kong and Chinese companies listed in Hong Kong, and further lets international investors buy China A shares listed on the mainland exchanges in a less restrictive and relatively seamless manner via the Hong Kong exchange. By all measures, it has been a tremendous success. At the end of 2020, foreign investors held $525 billion in A shares, and domestic investors held $270 billion in Hong Kong shares. Northbound Connect now trades $18 billion per day versus $13 billion per day in 2020 and $6 billion per day in 2019. Whereas southbound Connect now trades $7 billion per day today versus $2.8 billion per day in 2020 and $1.3 billion per day in 2019. For international investors, the program adds more than 2,000 companies to the investable universe. Connect has helped diversify the portfolios of investors, increase efficiencies for trading in Chinese and Hong Kong listed companies, and helped lead the way for Chinese shares being included in global benchmark stock indices. The program continues to evolve. Following the consensus reached in August 2019 between Hong Kong Exchange and Shanghai and Shenzhen stock exchanges on the criteria for inclusion of Hong Kong listed companies with weighted voting rights into the Connect universe. The first eligible weighted voting right companies were successfully included in southbound trading in October 2019. Additionally, last November, there was the very welcome announcement of the inclusion of the Star Market stocks into the Connect ecosystem, as well as pre-revenue biotechnology companies listed in Hong Kong for southbound trading. Of course, more still can be done. Investors are waiting for the introduction of additional products to hedge investor portfolio exposures, such as exchange-traded derivatives, for example, and the alignment of holiday trading and typhoon suspensions to offset real portfolio risks, such as price and currency movements, and further the introduction of northbound IPO participation and the inclusion of ETFs. However, there are some real challenges in the model which threaten to hamper the growth of the northbound market. T+0 settlement, coupled with funding and liquidity issues late in the settlement day, are some of the post-trade obstacles faced by sell-side participants in supporting clearing and settlement in the face of exponential volumes. Certainly, these need to be looked at in tandem with plans to develop and grow this market for international investors. This panel will explore many areas, including the important role Stock Connect plays as a pilot to explore developments in onshore access for the international and domestic investor community. For the continued development of Stock Connect, it will be tremendously important for both regulators and exchanges to listen to investors and to work together to create solutions and continue to drive both international and domestic flow via Connect to the benefit of China, Hong Kong, and the international investment community. With that introduction, now let us turn to the panel and address the first question to Simon. Simon, you've been at the forefront of advocacy for capital markets development around the region. As transformative as Connect has been for institutional investors, what is your take on where the program is now and what remains to be done to keep it relevant and competitive?
Cool. Well, thank you very much, John, and good morning, everyone. Thank you to ASIFMA for allowing me to participate today. This is a topic that I feel very passionate about, as I know a lot of people do, so very happy to share my views on it. I think first of all, I mean, Stock Connect as a channel has unquestionably been a huge success. You know, what began as a pilot scheme, as you mentioned, John, now has 360 billion worth of China A assets, about just under 70% of all foreign flows, and is a fantastic achievement that pioneers and stakeholders alike should be very proud of. It's truly enabled many international investors to participate in the Chinese market for the first time, and I'm sure it will continue to do so in the future. And just to kind of give you a little bit of a sense of the kind of scale with that, since the announcement of the first phase of MSCI inclusion back in June 2017, the holdings of China A assets have grown by $395 billion, of which about 80% has been included in the Stock Connect program. The key success of this pilot scheme has been the flexibility and the ability to evolve based on broad feedback from the industry and participants. I don't think I've ever witnessed such a constructive partnership between regulators, exchanges and industry bodies to solve what were the initial challenges of the program in its early days. And just to kind of remind people of the early enhancements, which really have made a massive difference to today, the introduction of special segregated accounts, we commonly know them as SPSAs, which allowed for, at the time, multi-broker trading, and that has been a huge success. There's currently just under 12,500 SPSA accounts set up. Only about 40% of them are active, but it just shows you how straightforward they were to set up and have been, and the potential interest in the future as people focus on this important market. To put that into context, over the same period, there's been about 230 QFII and RQFII accounts approved over the same period. Although I have to say that there is roughly about 88 accounts that have opened in the last year to indicate that the reforms in that channel are sparking a lot of interest as well. Other notable achievements include, you know, at the time, were 4 times increase in the daily quota ahead of the initial phase of MSCI inclusion. That was an issue that was thoroughly solved. In fact, we don't even talk about daily quota anymore, but those involved in the early stages will remember many meetings on that topic. I think also, but overall, I think it's fair to acknowledge that I don't think we would have had MSCI inclusion if it wasn't for the Stock Connect channel and its ability to grow and evolve to meet a lot of the investors' needs. You know, Stock Connect has been a fantastic foundation as a flexible pilot scheme, but what else can we do to further improve the channel? I believe that there's plenty that we can do and can be learnt in the process. And if we go back to the principles of Stock Connect program, I think there are 5 areas that could be tackled and would create lasting impact to the Stock Connect program and crucially help us understand what investors are really looking for and need in their future investment channels into China. So let me take you through these 5 topics. Many of them which we will discuss in a little bit more detail today. So I think first important topic is grouped as kind of post-trade and operational enhancements. I think there's been a lot said about the challenges of operating in a T+0 environment, and you know, the industry would definitely welcome further discussion in order to try to determine how extended settlements for sells to let's say a T+1 or a T+2 cycle would help international investors marry up their funds and trading around the world and give them time in order to process. I think the other aspect to the Stock Connect operational scheme that is worth mentioning and taking a look at, you know, after many years of experience, is going back to the kind of fundamental principles of Stock Connect. I mean, one of the things which was really important was creating a mechanism where it was not possible to fail a trade in the domestic market. And Stock Connect was built on the very core basis of having a pre-position check, which was developed by the exchange, and pre-funding requirements which were guaranteed by the broker community and who you were trading. So and this over time has proved to be very, very robust. I'm not aware that there's ever been a settlement fail in the domestic market, and nor that I would expect there to be one in the future, because it has been designed so well. But with that, matching settlement instructions in the CCAS and the Hong Kong leg of the trade, which happens each day, can be problematic. And the time flows associated with that and the T+0 market can be challenging for many investors. And I think we would all welcome a discussion in terms of setting the right level of penalty fees associated with unmatched trades in CCAS to marry up with the true reality that there really aren't any fails in the domestic market. We will touch today on other aspects that would also help the process, like stock borrow loan and other things. But I think the focus on setting the right level of penalties will ultimately encourage greater participation in the market without increasing any of the domestic settlement risk associated with Stock Connect. A second topic that I think is worth investigating further is Omnibus Trading. Now, we know that as Master SPSA, Master SPSA in the Stock Connect universe. That was a mechanism that was developed and implemented by the Hong Kong Exchange in 2020, and is the ability for fund managers with multiple accounts to aggregate their orders, trade at the same average price, and treat their clients' orders fairly. It had been a key industry ask from the very, very beginning. The concept of omnibus trading has definitely been very well received, although the current implementation of Master SPSA is quite complicated and does require asset managers to build many solutions to kind of deal with individual account checking processes. So one of the asks and further development points for Master SPSA is that the exchange could consider developing a centralized position checking utility to manage these market-wide requests. Not only would it create a lot of efficiency and reduce the burden on asset managers to effectively duplicate efforts to solve this solution, it's also been proven to have worked well in other exchanges like Taiwan, and would be a solution that could be created for all and be very beneficial. The third topic is around block trading. There is a lot of interest in it with across the industry about marrying up liquidity, especially as positions in Stock Connect get larger, and to help deal with that appropriately. So there is an ask of being able to participate in the block crossing window domestically, and also within the Stock Connect universe itself between participants. Now, there will need to be additional kind of discussion to be able to look and solve for that, but that is definitely a key aspect that the industry is after. The fourth aspect is holiday alignment. An ideal arrangement would be for Stock Connect northbound to be open on as many China trading days as possible, and vice versa for the southbound. And all efforts should be made in terms of trying to make that possible in the foreseeable future. And the last point that I think is worth focusing on in the context of Stock Connect is stock borrow loan. The Stock Connect program, we have learned so much from the Stock Connect program over the years in terms of how international investors want to invest into China. So aspects like pre-funding, extended settlement on buyers have all contributed to the success of the channel. I believe SPL would also be another area that would work well in a pilot scheme and provide some strong insight into the attributes that investors value. There is also the opportunity for reciprocality by opening SBL to Hong Kong assets of the southbound program. And the industry would welcome the opening of the program by acknowledging agent lending and broadening the eligible participants, perhaps maybe under a quota system to begin with, so that all participants can fully understand the benefits of this mechanism in a measured way. But overall, I think the Stock Connect program has been hugely successful on so many different metrics, and there is a real opportunity and learn and grow for the future by extending this pilot scheme. Of course, the immediate impact would be by taking Stock Connect to the next level. However, more importantly, it's what we can learn from foreign investors' interaction in the program that will be essential and valuable for the future as China develops its access channels for the future. And I will end it there, John. Back to you.
Thank you very much, Simon, for those insights, and a lot of the topics that you've highlighted we'll unpick a little bit further. But Tai, you've heard what Simon has to say. What's the current planning for Connect within Hong Kong Exchange, and what will we see? Will we see any of these requests come to the market in the near future? And what are the major impediments for driving change?
Yeah, sure. Thanks, John. Simon certainly has ways of really articulating really important points for Stock Connect enhancements. Now, this particular items that that's been already mentioned by Simon has been discussed with industry for quite some time. So on that point, allow me to just pinpoint quickly around the operational challenges that we have. Absolutely agree with Simon that the key challenges right now is dealing with T+0 settlement, essentially following the home market rules. The other issue is real-time delivery versus payment SI, which was introduced in 2017, but as an option to mitigate the counterparty risk. But however, there are some limitations as a result of that, dealing with the T0 settlement requirement, which then means that for the industry, essentially there's only 4 hours of limitation on allocation and settlement finality. So on that one, and obviously what we have observed are a couple of downstream, what we consider side effects as a result of these challenges. You're seeing a huge uptake on single-sided settlements. The industry typically deal with double-sided settlements, but single-sided settlement really grew quite significantly in Stock Connect. There are different tailored solutions and deadlines introduced by different intermediaries across the instruction flows, which then creates unique exception guidelines and differences between which intermediaries that the investors engage. Also, there are items such as mismatch of payment codes, limited exception resolution as a result of that, and requirement to switch DVP in the last settlement hour or so, and inflexibility to deal with cancel and replace or adjusting those instructions because limited time that we have. All of these are observations that we're seeing. So we are working with industry to look at some elements. Obviously, it's difficult for us to change the onshore Asia market regulation. However, there are things that we can do in Hong Kong that can optimize current element of the technology stack to make it more market friendly. We've KEX Synapse, which is the blockchain solution to standardize and streamline the post-trade processes and workflows. And with enough time, I can talk about that a little more later on. We're also looking at things such as new settlement instruction functions to change payment code for matched SIs. We believe that that will help custodians as well as brokers in dealing with time limitations. We are looking into perhaps adding additional matching runs and batch settlement cycles, as well as enhancing some settlement instruction matching logic so that the real-time delivery versus payment code will be instructed by the paying participant. And following that, by the paying participant rather than trying to wait and standard for dependencies on custodians to match that. So those are some examples that I highlighted. I don't know if audience understood half those technical stuff that I just mentioned, but we are looking into a lot of the solutions. Look forward to working with the industry on this, John.
Thank you so much, Ty, for your insights and the innovation and challenges going on to ultimately evolving the Connect infrastructure to everybody's benefit. Let's move forward now to stock borrow and lending. An efficient stock borrow and lending environment helps to enhance overall equity market efficiency, enables more efficient hedging to better manage risks, and also protects against failed trades that may arise due to tight settlement timeframes. So let's explore various aspects of the importance of a robust, transparent, and well-functioning SBL market. Kitty, if I may turn to you, what are the key benefits of a robust, transparent, and well-functioning SBL market for Stock Connect?
Sure, thanks, John. Glad to be here today. Thank you for participating and inviting me to the event. I guess just to answer the question, security borrow and lending is a very vital component of the financial market. Just to put some data into perspective, as of end of 2020, there are about 30 trillions of assets were available for security lending globally, and there are about 2 trillion on loan at the moment. Having a security borrowing and lending mechanism can invite different market participants and different investment strategies to come into the market, and this will enable and increase market liquidity, and in doing so facilitates transactions, which helps to mitigate price volatility and reduce transactional cost. In A-shares market, which retail participants always account for more than 80% of the daily activities, having a SBL mechanism in my mind can help to, with different investment strategy coming in, can help to rationalize the market during the high volatility days. In addition to the benefit I just mentioned, having an SBL mechanism, also will work quite well for tight settlement markets like Stock Connect, where it's T0, and as Tay alluded to earlier, there were only 4 hours, then the industry can work on the settlement cycle. And besides, working well for the failed trades, obviously having an SBL can also enhance portfolio yield for the long asset investors.
Thanks so much, Kitty. And given the importance of stock borrow and lending to the development of the market, and I'll open this question up to all the panelists, what are the possible opportunities to pilot developments through Stock Connect? And if I may, Kitty, let me continue with you first, and then I'll open it up to the other panelists.
Sure. I think possible solution, I think Simon has briefly mentioned earlier, I think it's worth looking into, continue to utilize Stock Connect as a pilot scheme, whether it's introducing and think about SBL mechanism for the northbound, which, as I mentioned earlier, can help with the settlement cycle. And if we want to put a framework or quota around it, so we can give, fully transparency into the onshore regulator to understand who's the ultimate end borrower or lender of the SBL mechanism. I think that's a solution. I think it's worth the industry to explore. And reciprocally, I think looking into southbound can be quite interesting as well. There are about 10% of the eligible southbound Stock Connect stocks at the moment, which holds around 20% of the market cap in the southbound. So that actually sucks up a lot of the liquidity from Hong Kong market. So I think having a look and pilot it using southbound could also be a good interesting idea. One, we can allow Hong Kong market participate in the southbound SBL, as well as can also worth looking into whether we should allow onshore mutual funds who are actually active participants of the southbound to look into participating in the SBL market onshore for southbound as well.
That's a very interesting kind of observation or insight. Tai, given the operational challenges or insights that you provided earlier, do you see any major impediments to I call it a China-Hong Kong SBL Connect, where underlying securities are made available for the liquidity of both markets?
Yeah, so it was very important when we initially launched Stock Connect back in 2014 to have a very basic framework of stock borrow lending and short selling scheme. Now, it is available, it is eligible. However, the limitation is the eligibility of, by definition, borrowers and lenders. Currently, it is limited to exchange participants. That means it's only available to exchange members from borrower to lender perspective. So that really takes out a significant portion of other intermediary players in space, such as custodians, as well as affiliates of the Hong Kong exchange members, which really tend to be either legal entities that are based in UK or other jurisdictions. That fluidity is extremely important, and it is something that we have engaged and we have discussed with the regulators before to make it a lot more flexible and inclusive by expanding the eligibility. So that's one element that'll help accelerate the development on stock borrow lending. The second area really is around dealing with the operational challenges. As Kitty noted, to deal with the operational issues of T0 settlement, and then when do you allow stock borrow lending, within what time frame of cutoff, and how do you tailor around payments that are associated with that when you have recall, for example. All of these elements are extremely important, and we do have to think very carefully about the operational design in supporting the expansion of eligibility there. The key challenge that I tend to see, John, in the last several years is essentially the industry are able to cope with things like pledge, where the title transfer does not necessarily take place, but the beneficial ownership of the shares actually stay within Streamline. But for this to be a little bit more flexible towards where the Hong Kong style of stock borrow lending is, there's still a number of regulatory guidelines that we need to look at, which includes title transfers. Of course, A-share market requirement is that the non-trade transfer is not allowed. Certainly poses a number of challenges there. But overall, definitely industry have ability to cope with the guidelines of the regulation. So where we think the initial important element to make a difference is expanding the eligibility, expanding the scope of the borrowers, the lenders. That's the initial step.
Fantastic, thank you, Tai. Kathy or Simon, anything else to add that hasn't been covered?
No, I think Chase hit the nail on the head and Kitty as well. Really.
Okay.
Yeah, the only thing I would add, John, is that, I mean, there are quite a lot of end investors that are not able to participate in the onshore market at the moment, just because of the mechanism that agent lending isn't acknowledged as a mechanism. So the proper kind of channels of collateralization just don't work at the moment. So I think to Tay's point about trying to expand and look at the operational challenges within the stock borrow loan mechanism in Hong Kong may provide some ideas in terms of maybe how to evolve the onshore channel to make it work for international norms and standards, so that all end investors could be covered. So I think there's a lot of benefits, not just obviously within the Stock Connect mechanism itself, but just wider learning about how maybe these programs will work in the future.
That's a great point, and it emphasizes the mechanism to pilot developments in Stock Connect for the benefit of the broader market thereafter. Now let us turn our attention to some of the operational challenges that sell-side institutions base in dealing with buy-side requirements and some of the recommendations that the panel may have. So Kathy and Kitty, if I may turn to you on this one, let's start with T+0, which presents many issues. What are the challenges and what are the potential solutions?
Thanks, John. How much time do I have? So T+0, it essentially boils down to T+0 and the challenges as a result that we face as participants in this market. So there are a few points that I'd like to touch on, and the most obvious one is operations. And so operational and settlement risks due to a very tight settlement window in which we have automatic buy-ins to deal with, time zone differences to deal with, and these all contribute to what we call a daily scramble. Also, when you consider that HKX, and quite rightly so, is trying to make trading easier, like introducing services such as Master SPSA, which Simon talked about earlier. This in a sense, though, whilst on one hand helping the market trade and make it more efficient, on the other hand, in a sense, compounds the operational issues that we have, because things like pre-allocations, which are currently required or were currently required in Stock Connect, are no longer visible to the brokers. So moving on to the second challenge, it's a second bucket of challenges, and that's really the bucket where I put funding and liquidity issues associated with all these things, right? Late timing of allocations, settlement instructions. And so as a broker, wearing my sell side as a clearer for brokers, we have to wait until these allocations come from fund managers, and that's only going to increase. And not assigning blame, but these can come in as late as 6:30 p.m. So this brings me to the next point in this bucket, which is really, guess what? We have very tight liquidity after 6 p.m. for CNH. And if you think about FX markets, and they typically, especially for CNH, typically trade on a spot basis, which is T+2, we're talking here about same day funding at a very late stage for CNH. So that's one point. And the third thing that is also very important to us operationally is really the mismatch, shall we say, of funding cutoff times with market settlement batch timings. And what I mean is the Hong Kong market works on multiple settlement batch runs that go on until past 7 p.m., whereas the banking system requires that payments are instructed and settle much, much earlier. So you really cannot rely on sales proceeds coming in to fund your purchases, because by the time the last batch run has run, and you realize some of your sales trades have failed, it's really too late to fund. So as a result, Kitty can talk at length about this, but the net result is a huge amount of pre-funding that brokers and clearers have to do in order to try to preempt the danger of failed transactions. And Kitty, feel free to jump in on the cost to brokers and clearers, especially on event days.
Sure. I'll just add a little bit there. So I think just to add on top of what Kathy has mentioned, there's multiple costs that I guess the sell side and also the clearer will need to take into consideration when it comes to support Stock Connect program, because it's T+0. There is a market settlement cost we need to think about if we are a net buyer. We also need to fund the client's sell trade, because as Kathy alluded to, we'll have to, fund the sell trade so that we can get the stock for the settlement to meet the market requirement. And on top of that, there's also China mainland security deposit, which we need to fund as well, which is it's a cost basically that's proportional to the Stock Connect flows that we see every day. So these are just the additional costs we need to think about. And I think the challenge is also it's very difficult for the sell side and also I guess the clearer from Kathy's perspective to predict how much every day how much flow is coming in to the brokers and to the clearers, especially during large eventful days like index rebalance, during overnight volatility. If there's huge movement in the U.S. and there's just a lot of inflow and outflow, through Stock Connect, it just makes it very difficult for sell side to put aside capital, not to even mention about additional costs we need to think about as part of the business. And even if as flows comes in during intraday, because there's a lack of liquidity in T+0 for CNH, it's almost impossible once it's afternoon for the sell side to even get the CNH liquidity. I think that poses additional challenges as well.
Exactly. I mean, those are very, very good points. Exactly what we're facing. So we see sort of the operational issues and the funding issues really hand in hand when we try to talk about Stock Connect issues. One last challenge that I'd like to consider before we move on to maybe some recommendations or thoughts around possible solutions is really the fact that we're dealing with an aging post-trade and settlement infrastructure in Hong Kong. So there's the limitations of this and the lack of flexibility do in fact hinder the ability of the market going forward to absorb more volume, especially when you think about the market, the predictions that Stock Connect's really growing, and it has done in the last year, but will continue to grow fairly exponentially. So in the interest of time, let's maybe talk about some possible solutions. I mean, it's not an easy one to deal with, because as Tay alluded to, this is a market that is essentially following the mainland market rules. So we can't sort of reinvent the rules to suit us. And while I know the foreign investor community would love to see a move to T+2 or even T+1 settlement, that would help. The truth is it's unlikely to happen in the near future. So we really need to find solutions and workarounds to try and smoothen out the process. So sort of going back to the challenges, so fundamentally we have this misalignment, and we need to align the underlying banking solution, shall we say, to meet the requirements of the market. And what I mean by this is we cannot continue to look at solutions for Stock Connect in a silo and just trying to resolve it and cobble together solutions from a settlements and operational perspective. We're still always going to be hampered by all the issues that we mentioned earlier, which are, CNH liquidity late in the day, payments and settlement cutoffs are not in sync. And this actually is going to impact what Simon talked about earlier, which is very important in terms of managing investors' risk. That's holiday trading. So until you can get to the bottom of that, it's really an impact because you're going to have to pre-fund your trades on a holiday, but it's impossible to predict, as Kitty says, what that number is going to be. So either we have to find a way to extend the liquidity window for CNH, or we need to maybe start to consider reconsider the onshore CNY funding option. And although rules are in place for, that really hasn't panned out operationally here in Hong Kong for reasons that we probably can't go into right now. The next thing is really the post-trade infrastructure, and I want to focus a little bit on that. One of the things is really an effective DVP settlement for northbound. I won't go into too much detail because the next panel is actually going to talk about DVP. But currently, just to explain, the normal market DVP settlement takes net cash settlement at the end of the day. That would be really helpful. However, it delivers cash only on settlement date +1. So what that means is that there's an overnight risk to that. And all regulated funds, such as the European UCITS, they actually have to go by regulation through a real-time DVP settlement mode, in Hong Kong Exchange. So that's called the RVP settlement mode, but requires the funding of gross purchases. So you can imagine this sucks up a lot of CNH liquidity, especially on an event day like rebalancing. So if, simply put, if DVP issues could be changed And Tay could probably talk about why they're having trouble with this. But if DVP proceeds and sale proceeds can actually be credited on the same day as on settlement date itself, I think that would alleviate the issue tremendously on liquidity. The second part is probably worth spending some time on, is a couple minutes probably on Synapse, which is really a post-trade platform based on smart contracts that HKX is building. So it's quite a bold solution that's trying to make the trade status visible to all parties in the chain simultaneously, and sort of, we hope, trying to manage and save some precious time. So maybe Tay, if you'd like to jump in there and talk about Synapse, give a little bit of flavor about Synapse, and that would be helpful.
Sure. So you're absolutely right in a sense that the current challenges that we have operationally, and in order to be able to address that, is really the industry's current dependencies on the sequential-based settlement and trade confirmation information flow. So from fund manager to custodians, fund manager to brokers, all the way downstream to global custodian, to local custodian, to clearing match. Together, the other side is the executing broker and clearing broker and exchange match, these instructions. All of these elements, typically in today's universe, it takes 2 days to confirm and affirm these informations. Through blockchain, what we are designing to do is have all the parties be able to see the sequence and real live status of the information and instruction on real-time basis, so they could all see it simultaneously. So rather than waiting for your predecessor to give you the instruction that has been pre-confirmed, you can now see as things happen in real time across the entire value chain of your settlement leg. So we do believe that'll accelerate the information that's required for participants to really condense the dependencies around the operations on settling the trades. So we do believe that that will significantly help and accelerate the efficiencies for the industry. For the prepayment as well as the payment issues that we have for the industry, and this is something that Simon mentioned earlier about holiday trading. And all of these elements are correlated because the security settlement cycle has to be in sync in Hong Kong together with the banking payment cycle, especially if you want to enjoy real-time gross settlement currency benefit. And to that end, our HKCC is in batch cycle linked together with the HKMA's HKICL payment cycle, so that the payment of the confirmation of both debit and credit is matched on real-time basis together with the instructions that are confirmed on the securities level. That, as much as it is a benefit for using RTGS currency, it creates dependency to the banking payment system, which means that we need the banking payment system to be much more flexible to cater to some of the additional requirement of security settlement cycles that needs to be had to be able to address those concerns. Holiday trading, we can settle trades at any time. The challenge is when the bank payment system is closed in Hong Kong during Good Friday, which is a Hong Kong holiday, and China is open, you cannot do real-time delivery versus payment because bank payment is closed. So we have to look at these things, and perhaps one way to deal with it is do it in sequence. There are certain things that we can do a little bit easier, but ultimately we need to go towards the big solution, which then require a lot of solution together with the Hong Kong banking payment system.
Thanks. Kitty, did you also want to talk about maybe
yeah,
FXs and
yeah, I'll just add. Yeah, I'll just add two more quick points in the interest of time. I think two more possible solutions I would urge people to consider, or maybe Hong Kong Stock Exchange to consider, is one, Hong Kong Stock Exchange has already made the enhancement to take Hong Kong dollar and US dollar as a prepayment from the brokers or the clearers, which helps. However, I think the limitation from the clearer or the broker is that we still will have to return or deliver CNH early in the morning on T+1. Given the liquidity for CNH on T0 is very tight, I think this solution is rather challenging. It would be great, I think, if Hong Kong Exchange can, work with HKMA or maybe SSC to directly tap into CNH or CNY with the help of onshore to help, the industry with this. The second, suggestion we have is the China security deposit that I mentioned, which is related to the trading volume that each broker needs to support. Currently, the broker will have to put aside cash just to support that, which is an additional cost to the business. It would be great if Hong Kong Exchange can consider whether, other than cash, whether it's possible to take other assets, whether it's equities or bonds, instead of cash. I'll stop at that. Thanks.
And John, just one thing that I'm going to say is I think confidence in operational processes from an end investor's perspective is just critical for the long-term success of the Stock Connect channel and any channel in general. The kind of scrambling that Kathy mentioned and all the different duplicate funding processes that Kitty highlighted are actually some of the real big benefits of Stock Connect in terms of how we've got to and how successful the channel's been. It's created a lot of flexibility and we've learned a lot about, perhaps what people and investors want in a channel for the future. I still haven't really given up on the basis of trying to solve for T+1 or 2. I look at markets like Israel and Russia in the past, which were T+0 markets, and how they solved that for international investors to begin with before they implemented it into their domestic market. I know it's a long-term perspective, but it's definitely something that is worth considering. So I'm going to stop there, but I'd love in the future, in 5 years' time, that we are not talking about operational issues with respect to investing in China, and we talk about the Chinese market as the basis for investing in that market.
Thanks very much, Simon, Kathy, Kay, and Kitty. I think that was a fabulous discussion on the operational challenges that will support the growth of the market. But what's really clear is the continued development of Stock Connect is going to be tremendously important for both regulators and exchanges to listen to investors and to work together to create solutions that continue to drive both international and domestic flow via Connect to the benefit of China, Hong Kong, and the international investment community. With that, let me close by thanking the panel for their contributions today and contributing to a fabulous discussion on strengthening the Stock Connect channel. Thank you very much.